Good morning and welcome to our second day of our TaxWare annual seminar. We are thrilled to be here with you this morning. Thank you for taking the time to, just kickstart off the new season and get to know your software even better. I am thrilled to announce Mike Nielson will be speaking today. He will be speaking on the topic listed there, Wintax 1040 and new tax laws. Just a couple housekeeping items. There's a Q&A at the bottom that you are welcome to ask any questions there. Once the questions are answered, they will be public for everybody to see. So you can use that button there. As if you've been to any of our other sessions, you know that we are drawing for prizes. The prize today will be a Textalent subscription. So Textalent is one of our partners that we have that actually integrates with our software. And so if you have never heard of them, we definitely have some webinars that we've done in the past, but textalent.com is the place to go get more of that information. So we will have somebody, one lucky winner today that is going to win one of those subscriptions. This session will be recorded and it will be available on our blog on our website later on this afternoon. In fact, the sessions from yesterday are already uploaded and posted. If you were to go to taxwaresystems.com and you were to go to the news section, then you would find our blog there, and you will find that information that was just started and updated yesterday. I think without further ado, I am going to introduce Mike Nielson. He's an enrolled agent and has worked with TaxWare Systems for over 30 years. In addition to his role as a programmer and lead coordinator of electronic filing for TaxWare, Mike is a practicing enrolled agent. He began his career while in school, working in his father's local California tax office. Today, Mike helps build our powerful in-house tools that support tax compliance, technologies, meet the needs of our clients, and adhere to IRS regulations. When he isn't in the office, Mike really enjoys fly fishing, kite surfing, and spending time with family. And of course, most importantly, his darling granddaughter. Please welcome Mike Nielson.
Thanks, Catherine.
You're welcome.
Oh, good morning. Is my video good? It's a little bit off. Okay, today we're going to go over the new program and the tax laws. The organization of this is going to be going over the we're going to go over the changes to the forms, some of the tax laws, and then we're going to go over the preview of the whole tax return. So that's at the end of it, it might be a little basic, so I won't be offended if people check out after the main forms and the tax law changes. Anyway, we'll continue on. We'll get into this here. Let me get to the next screen. Okay, so yeah, this is what we're going to cover here. We're going to go to changes to the forms. We made some changes on the 1099s. We added the 1099K input. We added some things to the direct deposit. A lot of the changes that we have in taxes this year are basically undoing the temporary things that we had for the COVID exceptions or COVID rules or COVID benefits. Also, that includes things that were with the EIC independents. The IRS has, I think they're in their final, when they introduced e-filing of 1040X, there was a kind of they had different stages of what was going to be allowed. So we're almost to the point where they have 1040X in full function, but we'll talk about that when we get into it. So let's go ahead and get started with the changes to the forms. So here's the 1040, here's the 2021 1040, and here's the 2022. The major change that they did this year is they added more things to the 1040. So if you look at in the section where I've got it highlighted, they added lines. It used to be a line 1. Now they have 1A through 1I with a total of 1Z for the total lines, which used to be just the one line for wages. So we're getting farther and farther away from that postcard tax return. We just keep adding more information. Now, we did go to it's probably 3 or 4 years now because it was pre-COVID. We went to a software developers conference, and one of the speakers on the forums from the IRS was there, and he was talking about how they are working to put lines for everything that's going to be on the tax return. There used to be, there's less and less. We still have them, where you have items that would add into a certain line, and then it will have a little code or a literal that it would type, that we would type on the dotted line, and that information gets e-filed. But now a lot of those have their own lines. So let's go ahead and look a little closer at these lines that are on here that they added. Now, most of these things are not new. They either moved from another place, or they were items that used to be added into that, to just the wage line with the little, the literal that printed on the dotted line. So we do have input for there's the household employee wages that could be input on that. The tips is coming from the 4137. So when you go to the input screen for the Schedule 1 and you click on the button for the tip income, it'll take you to the 4137 where you enter in your tip income, and then it'll carry the amount back to this to the page 1. The Medicare waiver payments, that would be if there was the Medicaid waiver payments. That would be if it wasn't reported on a W-2. We're going to talk a little more about the Medicaid waiver payments that were reported on a W-2 and whether or not they're taxable or not, and how to handle that. But this would be if it wasn't on a W-2 and it is taxable, then you'd enter that in there. The dependent care benefits and the 8839, those come from the forms. Those are if you had dependent care benefits or employer provided adoption benefits, and the expense and the amount of the benefits that you received or the client received was greater than the actual expenses that were involved, then that becomes income. Same thing with it. And then there's the wages from the 8919. Now the line 1H, that has a few, that's a little bit of a catch-all. And so there's a couple things that we definitely know carry to that line, and the program automatically deals with those. One of them is when you key in a 1099-R, the pension income, and you have a code 3 for disability, the program asks you whether or not the client has reached the minimum retirement age. If they have not reached the minimum retirement age, then the IRS that can be considered as earned income, and it carries up to this line 1H, and it does type in a description next to this 1H and puts the dollar amount in there. Now, that used to be one of those items that, like I say, it's not new. Program did it last year. It just added to the regular one, the wage line number 1 last year. Same thing with the foreign earned income, foreign earned compensation. That's foreign earned employer income. Also, if you have in the program, we have the clergy worksheet or the minister's worksheet, and there's the section that has the housing allowance, and then you fill out what the actual housing expenses were. And if the housing allowance is greater than the expenses, then it'll carry over to this line 1H. Now, I put a little maybe earned income items from other income on here, and we're trying to get some clarification. Unfortunately, the instructions make no mention of that carrying in there, but the IRS has a new business rule that, in regards to the earned income credit, that they're looking for items in order for how they're looking at what earned income is. They're looking at wages and Schedule C income and whatnot. Now, in the past, we've had the option to enter in on the other income, what used to be the line 21. Well, actually, a long time ago, it was the line 21 on the 1040. It's the line 1.8, I think, on the Schedule 1. For the other earned income, for other income, and you type in your description. A lot of types of people, we'd put in 1099. That's where we carry the 1099s if you indicate that it's going to other income, and then we would indicate whether or not it was earned income or not. If it's earned income, then we would compute the self-employment tax on that, and then we'd also add it to the earned income calculation to figure out the earned income credit. So anyway, We're waiting for some clarification, but this may be the place where we're going to see other income items that are designated as earned income. And as soon as we get the clarification on that, then it may be that those amounts are going to show up on that line 1H on the 1040 instead of the schedule 1. So unfortunately, the instructions are not clear, and we haven't heard back from the IRS on that yet. Okay, and then the other item that's on there is that line 1I, which is the non-taxable combat pay election. And that line was actually, I think it was on page 2 of the 1040 last year. And that is an indicator that you want to consider the non-taxable combat pay when computing the earned income credit. So the program will automatically do that. If you key in the W-2, there's a code for non-taxable combat pay, and then that will carry over to the earned income credit. If your earned income credit is better by including that, then the program will print out the amount on this line 1I, and then it'll compute the EIC on the greater amount to give you the higher EIC. Now, that does not add in, you're not really making a choice of whether or not including that income is better off because of the earned income credit, in spite of it, because that's just a notification that you are using the non-taxable combat pay, because it doesn't add into the line 1Z. If you look at the instruction, the line or the form, it says add lines 1A through 1H. So we're still not having to pay the taxes on that non-taxable combat pay. So that is the 1040 new lines, whole bunch of new lines, but not a lot of really new information on that. They just move things around, and they have lines for it instead of having little write-ins. So then the next one we're going to look at is on the schedule 1. Again, they added more items on here. Now, if you look back at the forms a few years ago, you'll see sections of it where it would say additional income, and there used to be little check boxes next to a form number. I think that those, like the 8853 and the 8889, they used to be a little checkbox that you would add, and then you'd indicate that that's where the income came from. So like I say, the IRS is trying to get everything on forms, so everything has its own place. So makes the forms a lot bigger, but in the end, I think it's probably better because things have their place, and you don't have these codes that you have to try to figure out what that actually means. Like on the 1040, we used to have the DCB for the dependent care benefits. There was a handful of codes, and sometimes it was not easy to see where that was coming from. And sometimes we'd get calls saying, hey, our wages don't match what's going on. And it was because it was carrying over and putting that little code in there. So anyway, I think it is a better change, but it does increase the number of forms that we do with the tax return. Okay, so on the schedule 1, they did add this section down here that I have highlighted in yellow, lines Q through U. And all of these are accessed through you'd go into the schedule 1 right off the line input menu, or on the 1040. I'll show you that in a minute, but we'll talk about these lines, and then I'll show you where the input is on those, just in case there's any question on there. So the other ones, most of them are pretty self-explanatory. There's one that I really want to talk about, that's Medicaid waiver payments. On the Medicaid waiver payments, this is, so I have a little bit of information on that. We used to have input under the other income section, and we had it in there as notice 2014-7. So that is the non-taxable, that's the non-taxable portion, or when you're excluding the Medicaid payments for, indicating that they're non-taxable. So the general rule on that is that if you have Medicaid payments, now when I've seen that as on the Medicaid payments is usually where there's a child or a person that may be taking care of their disabled child, or maybe they're taking care of their parents, and they get paid through the Medicaid to care for these individuals, and they may or may not be related to them or not. But and the interesting thing about it is that the W-2, they get a W-2. What I've seen on it is they get a W-2. The W-2 has the same employer ID number, depending on, for who's paying it. But then when it has the payer name, it'll have the individual's name that they're actually caring for. So I know the first couple of times I saw those, I look at it and I say, well, who's this? And it happens to be, I say, oh, they got a W-2. I go, who's that? They go, oh, that's my mom. And I go, wait, what? And that's what it was. It was the Medicaid payments that they were getting paid to care for their mom. Now, the general rule on that is that if the mom lives with the caretaker, then you don't have to, then it can be excluded from income. If they live in separate homes or they maintain separate homes, then it doesn't qualify for the exclusion. Anyway, if you want more information on that, I do have the link right here, but that's kind of hard to take notes on that. But if you just go to the IRS website and search Medicaid, it'll come up. I think the first thing that comes up is the little FAQ, and it talks about who qualifies and who doesn't, and it has different scenarios of who, people living in the house or not. So anyway, the main thing is that if you've had people in the past that qualified for that exclusion, or the exclusion for the Medicaid payments, it now has its own line, and we labeled it the same as they do on the form, which is the non-taxable amount of the Medicaid waiver payments that are included on the W-2. So this would be it was on the W-2. So you report the W-2 so the IRS knows that you're reporting it, and then you go and you take it out. You'll enter it in as a positive number. And then because it's got the brackets here, then the program will subtract it out to come down, and could come up with a negative income here if that's the only thing that's on this part one of the additional income. Another thing just to mention on the scholarship and fellowship grants not reported on a W-2, we get a handful of calls every year, and people want to know where to put in the scholarships if it's not taxable. And the answer to that is that if it's not taxable, it just doesn't go on the tax return. You don't need to fill anything out to indicate that it's not taxable. I think the assumption is that it is not taxable, but if it is, then you'll go ahead and add it in. So you don't need to do that. And that's the same thing with the distributions from the 529, the education IRAs, or the Coverdell IRA. Can't remember what the current name for that is, but on the education IRAs, there'll be I think it's a 1099-Q, I think is the form that you'll get to report that. And when you look at the instructions on the IRS, is that if it's taxable, then you add it in. And it used to be where you add it into other income line. Now it goes to, we have a line for it for the for the scholarships and fellowship grants. So if it's taxable, you add it in. If it's not taxable, then you leave it off the tax return. So that's a Schedule 1. Let me just show you real quick where the how we'd get into the input on that. Let me recall my test return here. So for those other items, if I go to the line input, that seems to be what most people prefer. We have all these lines here for the income, and we have all the new lines for the lines 1A through 1H. And when you go into those, it'll take you into the like on this one, if I go to the Medicaid waiver payments, what it'll do is it'll take me to the other income adjustments and payment screen here. And then I do have to go down to the other income. And then as we keep adding more specific lines, we just put them on the program. So we do have it down here, and we have the non-taxable amount of the Medicaid waiver payments down here, and you'd put in the amount. So you put it in as a positive number, and then it'll take it out and it'll reduce that. Now, let me just jump back. If I close that back out, it'll come back to my line input screen. If you go to the forms and schedules, if you like to choose your input based on picking the schedule A or B or whatever, that will be under this 84 other income adjustments and payments. If you're using the forms and schedules menu, that other income adjustments and payments is kind of the catch-all. If it doesn't have a form or schedule, this is where it's probably at. And we get into that same menu there. Okay, so we'll jump back to as soon as I get rid of this screen. There we go. Okay, so that's the schedule one. Again, changes to the forms, but not really a whole lot of change in the actual tax return. Another change area where we made some changes was on the 1099s. First of all, we used to have input for, you'd go in and put in a 1099 RP is what is called for the 1099 R pension. And then we'd have input for the 1099 RI, which is for the IRA 1099. Now, it's been quite a while since we actually had there used to be a 1099 IRA. But then years ago, they combined it to one form and they put a little checkbox on it. So we've just had those two different forms for quite a while. And so this year we finally bit the bullet and got rid of the distinction, the categories or in the grid of whether it was a 1099 IRA or an R. And I think it's a lot better because more than once I have keyed in a 1099 R and I've keyed it in under the 1099 R input section. And then I realized later that the little checkbox is checked that it's an IRA. And I go, oh, shoot. If I want it to show up on the right line on the 1040, then I have to go out and I have to delete that item, re-add it, and then have it show up again. So now if I go in and let me go ahead and bring up the program again. If I go into the screen, now if I go in and I pull up one of my 1099Rs, we have the checkbox here, which is in the same places where the form is. And I indicate that it's the IRA. And you'll see the screen changes a little bit. That's because there's certain things that are available when it's a 1099 IRA or if it's a pension. So not major changes, but this simplified worksheet, we don't have that for if it's an IRA. And then there's also some changes down here, whether if it's an IRA, then you have the conversion from a traditional IRA to a Roth IRA. We have those options. So anyway, once you mark that it's an IRA, then when I come out, then it will show whether it's a pension or IRA, and that's going to indicate which line it's going to go on the 1040. So I like that change a lot because, like I say, I've actually had to rekey 1099Rs because I put them in the wrong place. So other than that, it's pretty much the same. Now, while we're looking at these 1099Rs, there is another option, is that if for the RRB. So if I go back into one of these items and if I mark down here at the bottom, where to go? Oh, I guess it only it only shows up it only shows up if it's a 1099. If it's not an IRA, because that would make sense, because on an IRA, it wouldn't be an RRB. Anyway, the RRB is the railroad retirement benefits. And so if people retired from the railroad, they will get their RRB, or the railroad retirement would be the tier 1 and the tier 2 retirements. So if I click on this box, then it will convert the screen to be in the same format that the 1099 RRB is. So for the railroad retirement. So the tier 1, which is the equivalent of Social Security, will just take you to the Social Security benefit statement input, and it's keyed in just like it would with the Social Security benefits. And then when you're done, it brings you back to the RRB, and then here's the input on here, and the program goes through, and a lot of times you might want to use the simplified method worksheet, because the RRB 1099s don't always compute the taxable amount, and they could have some employee contributions, which would make a portion of it. It's usually a small portion that's not taxable. But anyway, so that is how the program, you can switch back and forth, but you would start it out as a 1099-R, and then you would check the box that it's the RRB, and then it'll give you that other menu, and it'll be in the same format. Now, it all gets reported to the IRS as a 1099-R, but the format of it is a lot easier to work with when you indicate, when it comes on a 1099 RRB and when you input it. So that is the 1099-Rs. And then we have the W-2Gs, no change there. And then we down here in this section, we used to have a section for the 1099 miscellaneous, and then we had a section for the 1099 NEC. When the IRS came out and started sending out had the 1099 NECs, and the 1099Ks are not new, but with the talk of what's happening and how many 1099Ks and the requirement of the 1099Ks, there's a good possibility that we're going to see a lot of those just this year. So we did add the 1099K input screen. Now, let me go back to my PowerPoint. So first of all, when it comes to the 1099 miscellaneous, the 1099 NEC, and the 1099K, as far as the IRS is concerned, they don't get, when we fill out the information, let me back up a little bit. When you fill out a W-2, or you fill out a 1099-R or a W-2G, everything that you put on that screen, the IRS gets. So they get a record of who the payer name is, and that's all required. Who the payer name, what the employer ID number is, all of that information, the withhold, the total income, everything that's on those screens, the IRS gets a record. There's a W-2 record, there's a 1099-R record, and the IRS gets that information. The 1099 miscellaneous NEC and the K, IRS doesn't have any way for us to send that to them in a 1099 miscellaneous record. They don't really care about getting that information. Well, apparently they don't care about it because they don't ask for it. So whether or not you want to key the 1099 miscellaneous NEC or K in is up to you. Now, there is a little bit of a exception to that, is there's a few states, I know California is not one of them. And the only one that I work with, there's just a handful, I would say half a dozen at the most, that the state actually wants to see the 1099, and they normally only want to see the 1099 if there's state withholding on the 1099. So I don't think that that's very common, but if you do have a 1099 with state withholding, then it probably would be a good idea to go ahead and key that 1099 in. Otherwise, if you're doing client comes in and they have a business and they come in and they give you ideally, they give you an income statement, and they've given you, here's my total income that I have for the year. And then they also give you a stack of 1099s. If it's me, I look at the 1099s, I add up the totals on there. I see if I talk to them and say, well, does your total income that you're giving me here as total income, does that include the amounts that you received from these 1099s? And the answer should be yes, if it's a financial statement. So they say, yes, that's the same. Then I don't care about the 1099s. I don't need to input them. I don't need to key them in. And that's the IRS's stance on it too, is that's basically the 1099s are basically, the IRS is going to look to see if you're reporting the income on the tax return, whether it's going on to the Schedule C or it's going on to other income. Um, so anyway, that's my push on the 1099s. Now, in some cases, it does make it more convenient to enter in the 1099s, and we get a lot of calls, and people like to key them in so they have record of it. And so the like I say, you're more than welcome to key that in. So on the 1099s, we got a few things to talk about. On the 1099K, we added the 1099K, and we've been on a few calls with the IRS, some conference calls with the IRS, and they've talked about what they're going to do with these 1099Ks, because the worry is, and we don't really know exactly, at least I don't know exactly, maybe other people do, but exactly what's going on, because I know that there's different, the 1099Ks are going to be PayPal, eBay, I think Venmo, all these companies that are not necessarily collecting the money. They're not paying the money. They're just the conduit for money to come and go. That's the thing. That's the items that are going to be on a 1099K. So the big worry is that when friends are sending money to other friends, or people are sharing expenses and they're passing the money back and forth from Venmo, at this point, we don't know how many of those people are going to get a 1099K. And the question has come up to the IRS and asking what is the IRS is going to do about these. And I think they said they were going to contact the taxpayers to find out why they didn't include the 1099K and whether or not it was taxable. So I think that's the last thing we want to happen, is the IRS contacting all of our clients that have a 1099K because they shared expenses for a weekend trip or something, and they paid their friend, or they received money from their friend for sharing expenses from a weekend trip, and it got paid through Venmo, and Venmo for some reason labeled that as business income. So that's the part that we just don't know, and the IRS doesn't really know. The one in one of the conference calls that we were on, and the IRS was there, and they did say, they said, well, if you want, you can go put it in. You can go put it into other income, report it on report it on the other income, and then subtract it back out on the other income. So that we in the 1099K input section, we do have an option to do that. Let me see if I had that. Yeah. So here's the input screen for the 1099K. Now, another disclosure item here is that what the information that the program is going to use, and the information that's going to be used by the, going to the IRS, that's going to show up on the tax return, is going to be the gross transactions, where it's carrying to. So on this carry to form, it's going to be either the Schedule C or other income. There's an indication on whether it's earned income, so that if it's going to the other income, it'll be flagged for the self-employment tax, and earned income for EIC purposes. We added this line here for the amount not taxable to the recipient, because I guess there's a possibility, we're thinking that there's a possibility that could be somebody that actually does receive transactions, business transactions on their 1099K, but then they also receive transactions that are not taxable, that were just reimbursements for expenses of some sort. So we do have that. So what the program will do is it'll put in the gross amount on the other income, and then it'll put a negative amount, say in the non-taxable portion of the 1099K, and that'll show that number will show on there. That's if you're carrying it to other income. If you're carrying it to the Schedule C, then the program's going to carry the whole amount over to the Schedule C. And there's not really a way on the Schedule C other than going down to the expenses section and to then enter it in. And so since there's not really any clear instructions from the IRS on how to deal with those situations, we didn't feel comfortable doing that. So if you're carrying it to a Schedule C, it's going to carry the whole gross amount to the Schedule C. And then if there's non-taxable portions of that, then you'll probably want to go down to the expenses and then describe it in the other expenses section, and put it in as a negative, or actually it's an expense, so you put it in as a positive number, and then that'll reduce your net income, so you're not paying taxes on that. As far as we filled this in to match the form, but the program's not going to do anything with the monthly input here on these items here. If you want to have it for record purposes, you can do that. But like I say, the program's not going to use that for any information. So I don't really see a need to key that in. I think between the two of those, I think that covers if we go back, the other, so that's a lot of talk on the 1099K, the 1099 miscellaneous. We don't see as many of those anymore, but that's just miscellaneous income. And the same thing with the 1099 NEC, but they'll all carry over to the either a Schedule C or the other income. And like I was mentioned before, there's a possibility that we may be, right now the program is carrying it to the Schedule 1, line 8, other income line, and it puts the 1099K information on there. There's a possibility that that may change a little bit, and we may be pulling the earned income, anything that's identified as earned income. We'll leave the input the same because it's all in one place. But then if it's earned income, those amounts may be reported on page 1 on that line 1, I think it was, but the one that we talked about in the beginning. So again, we're waiting for some instruction or some further information from the IRS on that before we make that move. So we have this little note. Oh, on that notice, we have this little notice that pops up on the 1099K. Let me show you how to get rid of that once you're ready to, once you've seen it enough. So it pops up every time you go into the 1099K, comes up here. So if you want to get rid of that, then you check this box right here, and then that little notice won't show up. And then if you want to look at the notice, you can just click on the box. Here's the notice telling what we're doing with it. But here's the input for it. Like I say, you tell it where you want it to carry to, either other income, or now I've already created a Schedule C. So it's looking at my Schedule Cs that I have within the system. And so I can carry it to the existing Schedule C that I have, or if I want to, if I haven't created this schedule, you could, so what you could do is, if you get the 1099K, you fill in the 1099K, and then you say create. When you leave it, you tell it to create a new Schedule C, and then it'll create the Schedule C, and it'll carry the information over there, and it'll create a new Schedule C for you. And then you do have to go back to the Schedule C in order to put any expenses that go along with it. So, and if I do tell it's going to the Schedule C, then I lose the option to put in the non-taxable portion of it. So, but if I go back, tell it to other income, then I have an option to indicate whether it's earned or not, and if there's a non-taxable portion. So that is the 1099K, the 1099 NEC, and the miscellaneous are similar, where you tell the Schedule C amount. This one's a little bit different because you don't tell it whether it's going to the Schedule C or the 1040. You just tell the amounts that are going to the 1040. So when you're keying it in, you choose whether there's one box on the 1099 NEC for non-employee compensation, and you choose whether, by putting it in either Schedule C amount or other income amount, whether it's going to go to a Schedule C or if it's going to go to other income. Again, you can have it carry to the existing Schedule C. And so that is the 1099 input for miscellaneous NEC and 1099K. Okay, let's go back to. Okay, the IRS, I don't know how many years ago, maybe it was when they first came out with the form 88, 88. Are my numbers right? Yeah. 8888 for the, basically it's the direct deposit of your refund. And first you could do, we first had the option, you could do direct deposit into one account. Then they decided, oh, you might want to split it up between a second and a third account. And I think their reasoning is that you could have it fund an IRA or something like that, which you can, or you can split it and whatnot. And my opinion on this has always been that the direct deposit information, I spend a lot of time making sure that I have the right routing number, that I have the right account number, that the client still has, if I recall it from a prior year, that the client still has that same bank account, that they didn't transfer it to a different branch in a different area where the routing number may have changed, all the rest of it. So last thing I want to do is foul up on my direct deposit information. So I'm not, I don't encourage anybody to use a second or third account when I'm doing a tax return, because I've always felt that that's just doubles or triples my chance of of getting something wrong on the direct deposit information. And then it kind of goes into the refund, kind of goes into limbo for a while. But anyway, they do have the option to split the refund. Anyway, back to what I was saying is that as soon as the IRS offered that, we added that in. At some point, they had the option of being able to buy the U.S. savings bonds. And the first year they came out with that, we didn't support it. And we thought, well, we'll see what happens and if people need that. And for years, we never heard anything about it until last year. And that may be because the interest rates were so bad last year. And so then people had an interest in buying the savings bonds. But we had a handful of people that called, wanted to be able to do that. And last year we didn't support it. So we added the option. So now you can go buy with your refund, you can buy US savings bonds. You have to buy them in multiples of $50. And so we have the option to go ahead and put it in. You can buy it for yourself. You can buy it for your wife. You can buy it for any other person. You put in their name. You could buy it for you put the names on kids, and you can name either a beneficiary or a co-owner. You indicate whether the co-owner, you put in a person's name on here, and you indicate whether they're a co-owner or if they're a beneficiary of that that savings bond. And you can do a couple different options on that, on who you're buying those for. And then we had to add, in case you never wanted to do any direct deposit, but you're just buying savings bonds, then you would have to put in the balance down here for the amount refunded by check. The program will automatically assume that anything that's not going to the savings bonds or the second account or the third account, that's going to go into the first account. So if you only key in the first account, then you never have to worry about telling it how much to deposit in the first account, because it just deposits the whole amount into that first account. But in the case that you don't want to do direct deposit at all, and you just want the remainder, because chances of your refund being divided equally into $50 increments are rare. So you may have a balance left over. And so you can choose to have that sent by check. You'll have to put that check amount in. Otherwise, the program's going to try and put it into the direct deposit account for the first. And if you don't have direct deposit information, then the program is going to tell you, hey, you can't do this because you don't have it. So anyway, we did add the US savings bonds. So I don't know, maybe now that interest rates are better, maybe there's no longer a need, or no longer a demand for the US savings bonds, but we do have the option for that, to do that. Okay. So that was, so those are pretty much the changes that we have in the forms. And now we want to talk about some of the tax law changes that are going on. And luckily there's not a whole lot of tax law changes this year. Most of it is just undoing the things that we had, unique things that we had because of the COVID laws that came out, to the benefits and whatnot. So the good news is we don't have to worry about the EIPs, the economic impact payments. We don't have to worry about trying to figure out how much they got. Nobody remembered, and most people, on when you first asked them, they didn't get anything, and then as they dig a little more, then they realize that, oh yeah, maybe I did. Or they adamant that they didn't get it, and then you file the tax return, and then the IRS came back and rejected it and saying that there was a problem with the calculation. The problem with the calculation is that they actually got it. Anyway, we don't have to worry about that. There's no recovery rebate credit. There's no advanced child tax credit reconciliation. So those are gone. The other thing, the student loan forgiveness will not be taxable if it happens, which doesn't sound like it's going to happen on that student loan forgiveness for everybody on the $10,000 of their student loan. But if it does, it is written in the instructions for the IRS that that it is not going to be a taxable item for the student loan forgiveness. The child tax credit, we got changes, and basically we went back to what the rules were back in 2020. So that 2021, the 17-year-olds, you get the child tax credit for the 17-year-olds. Well, that went back to where they have to be under 17. So you only get it if they're 16. The child tax credit just went back to a flat $2,000. There's no $3,600 or $3,000 amounts. Those are gone. It's just a straight $2,000 for the child tax credit. And last year, there used to be two different phase outs, a phase out for the additional amounts above 2,000, and then the regular phase out for at 2,000. So phase outs are back to what they were in 2020. So you don't lose your child tax credit until your income goes over 400,000 for married filing joint, 200,000 for the rest of them. Okay. So that will disappoint people, of course. Next thing on the line is the itemized deductions. The mortgage insurance premiums are no longer deductible as as an interest expense. So that's just gone. I don't know if it'll come back, but it doesn't look like it's going to. The charitable contributions for 2021, those were limited to 100% of your AGI. Now that's back to being limited to 60% of your AGI. So what that means is that if you had $100,000 AGI and you could only deduct $60,000 of charitable contributions. So there's not a whole lot of people that hit that limitation, but it does happen, especially when you've got people that have non-taxable income. We have two mileage rates for this year. So there's one mileage rate that goes through the end of June, and then we have another rate that goes from July to the end of the year. So for medical expenses, it's 18 cents for the first half, 22 cents for the second half. And then down here, I've got the business miles, or if it's used for business purposes, then you get 58.5 cents for the first half of the year. And then you get 62.5 cents for the second half of the year. And then the rate for the charitable, there isn't two rates for some reason on the charitable mileage rate, and that is 14 cents a mile. I didn't put that in. I still don't understand why. I would like to know why the car costs more money when you're using it for business than you are for medical or charitable. But I don't make the rules, but I do find it interesting that they have different rates for depending on what you're doing. They don't have the same type of limitations on other expenses as far as percentage wise and whatnot. Anyway, doesn't matter. So those are some of the changes. The other change, we've got the dependent care benefits. Again, dependent care benefits, the numbers on what people could possibly deduct last year or get credits for last year for the dependent care benefits, just like went through the roof kind of compared to what they were. For some reason, those limits that they have just never seem to adjust for inflation. And we're back to, you can only deduct the amounts, or the not deduct, but you can only use for the credit the amounts of $3,000 for one child and $6,000 for two children. And then the percentage that you get off of what you pay in 2021, it could be 50%. And so now that's down to, the high rate on that is 35% of the smaller amount. So what was that in 2021? I think you could take take a credit of up to $8,000 for dependent care benefits if you're using the max amount and you hit the highest percentage rate of 50%. Now the hope most you can do is 35% of 6,000. So a lot less. And the credit is not a refundable credit, where it was temporarily last year, it was a refundable credit. So you could get that money back even if you didn't have tax, but now it's a non-refundable credit. So if the tax is already brought down to zero, then there's really no benefit for the dependent care benefits. The other thing that's that did change was the solar energy credit. And I'm sure that everybody's heard it on the radio for all the ads for the solar energy companies, because as soon as that went back up, then everybody jumped back on, letting you know that that the energy credit is back to 30%. And it looks like that'll be around at 30% for a while. That was pretty much the only thing that wasn't a whole lot else that affected, at least nothing substantial in that Inflation Reduction Act. Now, one thing that kind of just everyone would be on these conference calls, and the IRS would refer it to as IRA. And I would have to retrain my thinking of what IRA was, because I've always thought of it as the individual retirement account, but the IRS sometimes refers to the Inflation Reduction Act as IRA. Anyway, the earned income credit, again, we had some really high benefits in 2021, and those are gone for 2022. And we're back to similar amounts that we had in 2020, but just those have been adjusted with inflation. But just as a comparison, there's a little chart there, and they really had the benefit where it jumped up really high for they gave extra money to the people that qualified for the earned income credit with no children. So in 2021, you could get up to $1,500, and now it's down to 560. I think 2020, it was somewhere around 500. And the limit, they dropped the limit back down to kind of go in line with what they were doing back in 2020. Now, the one thing that they didn't really drop down was the investment income limit. So it used to be that the investment income limit, if you had, Schedule D or interest income or rental income, I think in 2020 it was around $3,600, and then you would lose your EIC. You'd lose EIC if you had investment income of more than 3,600. 2021 they bumped it up to 10,000, and they actually bumped it up again in 2022. So you could get that. You could still get the EIC if you have investment income. The other rules is that on the EIC is they went back to just that the age of the the age of the taxpayers, at least one of the taxpayers has to be between the age of 25 and under 65, or they have to be at least age 25 and be under the age of 65. So last year they had some, I ran into, if you had somebody that was retired and they were getting and they had a part-time job, they might have qualified for earned income credit because they were over 65, even though they were over 65, but that'll be gone. That's gone this year for 2022. And then last year they had some exceptions for the age 25. It could go down to 18 or 19 if they were a former foster youth or a qualified homeless youth. Then they could get that earned income credit, or if they were not if they were a non-specified student, so they weren't going to school, they could qualify for the earned income credit. So now we're back to, they have to be 25, have to be between the age of 25 and 65 in order to qualify for the earned income credit. And also last year they had a provision to use the 2019 income if that was higher than the current income and your EIC was higher because of that. But anyway, that's gone. You look at the current year income and that's it for the earned income credit. Okay, so those are the main changes, tax law changes. So really not a whole lot of, not a lot of big changes that we have for the year, just the undoing of all the little COVID exceptions. The one thing that's still around, I just want to mention it was the 8915. 89, we started out the 8915, it was 8915E in 2020. And that was a situation where people could take money out of their pension income or their IRA, and they would not have to pay the penalty for early withdrawal. And also they could choose to spread that over 3 years. So they claim 1/3 of the income for 3 years, third in 2020, third in 2021, and a third in 2022. So now we've got that last. So the people that did that, you've got one more year where you need to claim that information and claim that income. If somebody did, they did have the option to go, and they could go pay it back. So they put it back into their retirement plan. If they do that, then they actually have to go back to the 2020 tax return, and they're going to amend that tax return and take it off of there. And now they probably need to amend the 2021 tax return. So they basically go back and amend it as if they never got it, if they repay it. If they don't repay it, then and they just pay the tax, claim the last 1/3 of it, claim it as income, pay the tax on it, and then they're done. If they kept the form name the same, it's the same form as last year, the 8915F. I guess there wasn't drastic that 8915. I think it started out as an 8915A at some point for the disasters, and then depending on how much they change the form, they give it a new letter behind it. But this year it stayed as the 8915F. And if you had one last year, that you keyed the return into the program, and it has that has an 8915F from the prior year, then the program, when you recall it, it'll automatically carry that over, and it'll fill in the information based on last year's 8915, and it'll all be automatic. If you do need to key one in from scratch and you're accounting for that third, I just highlighted the basic input of what you would input here. The calendar year disaster occurred is back in 2020. It was due to the coronavirus. They checked that box. And then if it's an IRA, then they'll have the amount here on this coming from the worksheet 2. They'll put that amount in. And this is the amount of the actual amount that's taxable. So if their original distribution was for pensions, other than IRAs, it was 30,000, then they would put in 10,000 for this 1/3 of the final year. Same thing down here on the IRAs. If there was IRAs, then, so this is the basic input that you would see on somebody that just took the money out, and they're going to pay them they're going to add the income of 1/3 for each year. So that's not really a new, but it's one last year that we're dealing with this. Okay. So on the 1040X, the IRS started the 1040X, or at least the e-file of the 1040X. They started it in 2019, and it had a few limitations on there. And then They went 2020, 21, and 22. So they had different stages or phases, I think. And so we are in the last, they were supposed to have the last phase as of January 1st, but now the only thing that still they don't know exactly when they're going to be able to process is the direct deposit of the refund. So the direct deposit of the refund, there, I believe they have it scheduled for where if you file an amended return, a 1040X, and we only support for if you file an amended return for 2022 and you have a refund, then you can request a direct deposit. They don't know exactly when they'll actually be able to support that direct deposit. They were saying that I think it was end of March, but then they said, but it may be sooner. So if you do an amended return in February, you can go ahead and put in the direct deposit information. It'll be down at the bottom of the screen, and you can put in the direct deposit information, and then that will get sent to the IRS. If by chance they're not ready to process the direct deposit, they won't reject the return. They will just send a check back instead. And I think that's kind of what they've been doing in the past anyway. Um, but the plan is, but the other limitations should all be gone. There were some limitations that the return had to originally be filed electronically. You couldn't change dependents. There was a handful of those, but my understanding is all those limitations are gone, and now you can support you can e-file your amended returns. So just for information purposes, know that when you file an amended return electronically, what's going to happen is that you're going to fill out the 1040X. Let's go look at it. So I'm in the amended return, and just while we're looking at it, let me just tell you the normal process that you'd probably want to go through if you have an amended return. So if somebody comes back in and they say, oh, I forgot this information, or we have additional information that we need. So what you'd want to do is recall the return, go into the 1040X, and then you'd click on this button here, which would carry which will carry what is on the current tax return right now. It'll carry it into the column, which is the original column. Then you'd go back and you'd make your changes if you wanted, if you're adding a Schedule B, if you're adding a W-2 or whatever you're doing, make it the changes that you'd do, you'd make those changes. Then you come back into the 1040X, and then you click to carry in this corrected column here. Now, mine are going to be the same because I didn't make any changes, but if the AGI was different, you'd see the difference, and it would show all the changes, and it'd make the calculation changes different on there. Okay. Then what you do is you go down, and it could be if you paid an amount with the original return, and then you put in the explanation, and you're ready to e-file it. Okay. Now, if you're going to e-file it, you check this box. And when you check the box, it'll give you some instructions on what the instructions for transmitting the return. So what you're going to do, once you check the box and you mark it as an amended return, then you'll go back in and you'll basically just retransmit this tax return going to the IRS the same way that you transmitted the return originally when it went to the IRS as an original return. And then when this box is checked, then it's going to send, and what the IRS gets is they get the whole tax return, or they get the new tax return with the changes on it, and they get the 1040X, which if they look at it, I think that that's great, because when you're trying to explain to them why the AGI changed and you're trying to make the explanation down in here, it's a lot of work to explain why this changed and that affected this and then it affected this and affected that. So they get the whole tax return. So I think that that's great that they get the whole tax return along with the 1040X. And then I think that the explanation down here, then it could be just changes to the AGI were due to a missing W-2 or whatever the case is on that. They added, this is a new line here. As part of the 1040X, you can indicate that the return is a superseded return. So a superseded return, if you're not familiar with a superseded return is a return that you can file a superseded return as long as you file it before the due date of the return. Then that new return is supposed to replace, so to supersede the previous one. So if you're doing everything by paper, you would reprint or you'd refill out the new tax return. You'd write across the top of it superseded, and then you'd mail it into the IRS. And then supposedly they would replace that. But in the calls that we've had with the IRS, it doesn't really sound like they supersede it. They just take and they make a correction to the original return. The other thing that's kind of interesting is they made a point of putting in the superseded return checkbox, which the superseded return, it is part of, it's an indicator, or it's it's an additional indicator that goes along with the 1040X. So like I say, if you were filing a superseded paper return, you would just mail in a new 1040. But the superseded return has to be accompanied with the 1040X. So, and then the question came up in the conference call that we were with when they were talking about the superseded return indicator. And the superseded return indicator, when the question came up on whether or not they were going to reject a return or whatnot, and they basically said that, well, we've pretty much, if we've received a 1040X before the due date, we've treated it as a superseded return anyway. And if we receive a 1040X that's after the due date of the return, and that checkbox is marked that it's a superseded return, then we'll probably just ignore it. So I don't really see why they bothered even putting it in there, because they're just doing the changes based on when they received the corrected return and the amended return. So, but we do have that box on there for the superseded return. And I guess to follow procedures, maybe they'll do things differently in the future, but that's what they were saying that they're doing right now as far as this superseded return indicator. So if you're filing the amended return and it's before the due date, then check the box. It is a superseded return. And if it's after that due date, then leave it unchecked. As far as if we make some changes here, if we put in the amount, say they paid $500, and so now they're getting a refund, then if there's a refund, then down at the bottom of the screen, then the program will have the direct deposit information down here for the direct deposit. Now it'll pull the direct deposit information that you had from when you filed the return originally. And so then it will try, if you originally did direct deposit, then it'll try and pull that out. Keep in mind that if you did a bank product, and you do an amended return, that it will try and, if it pulls the information from the main direct deposit information from the return, and now you're doing an amended return, you probably need to go down here and remove the direct deposit information from the screen here, because you probably don't want the refund to be sent to the bank, because then the bank will have to then issue the check, or they'll receive it and then they'll send it back to the IRS, and then the IRS will finally mail a check to the client. So so be aware that if you're amending a return for a return that you did a bank product on, then you make sure that you review where that refund is going to be direct deposited, if you want to even use direct deposit. So if you don't want to use direct deposit, then remove the routing number and account number down here at the bottom. And the same thing is if you had, let's see. know if this is going to give me. Trying to just cheat here and get a balance due. There we go. Okay, if you end up having a balance due, then if you go down to the bottom of the screen, then it will have the direct deposit information down here, or the bank information down here. And you will need to check this box here that says, do you want to use direct debit to pay the balance due? So you have to check that box in order for it to pay that. So it won't automatically assume that if you did direct debit when you filed the original tax return, that will automatically do it on the 1040X. You do have to check the box here. Now it'll pull the information that you had from the bank information, the routing number and the account number. But you needed to check the box, and then you need to put in the requested payment date, adjust that, and then I think it'll default and then you put in the amount that you want to pay. So it shows how much is due, and then you put how much you want to have automatically paid in. Oh, and then there's one more thing on when you're doing an amended return, is that you do have to do this manually. But then so if I did that amended return, then I'm going to go into e-file, and right here for the status, I'm going to manually change that to transmit. And I'm going to manually change that to transmit, and then I can go ahead and hit the button to e-file the return. And now, because I have that box checked in the 1040X, it'll send that return off with the 1040X. Then the other thing that you need to do on this is that you need to update the PIN signature date on the date that they signed the 8879. So the instructions on there, you're supposed to have, when you do a 1040X and amended, in addition to the 8879, you also need to have them sign the I think it's just the the page 2 of the tax return. They sign that, and then you keep that in your records. The same thing is that you do, similar to what you would do on saving the 8879. And we have those instructions on the 1040X screen. Okay, so that is the 1040X. Let me go back to my PowerPoint. Okay, let's go to the next. Okay, so that's pretty much what we wanted to cover for what's some of the changes that we did on the input, how we're dealing with some of the changes with the IRS, how we're dealing with the 1099K. I think that's going to be a little bit of a mess, and I think with a little bit of extra work, a little extra effort, we can hopefully avoid clients getting notices on why they didn't report income on the 1099K. I think it's worthwhile to put it in and have it taken back out. But for the most part, that is what we wanted to cover for the new tax laws and how we're dealing within the program. Now we want to go in, and I want to just go over and spend a little bit of time. And some of this may be, if you're very familiar with the program, this will all be just an overview, and it'll be rehashing information. But we're going to look at keying in a tax return real quick. We're not going to spend a whole lot of time on this. So if I start out, let me talk about this section here. This is the beginning program where you start a new tax return. So we have these three options, like, okay, I'm getting ready to do a tax return. So if it's a client that I've never seen before, brand new client walks in the door, I don't have any prior year information, then I would hit new client. This is a new client, and it'll ask me for the name and address and the filing status and everything else. If it's a client that I did last year, but I haven't seen them this year, they came in, I have last year's information, so I want to recall from prior year. So then I could use this option here to recall prior. Okay. Now, I personally, everything can be done. Both of those features can be done off of this one button here for the recall client. And the recall client originally, if you go back, I don't know how many years before we expanded this recall client screen, is that would be if I wanted to recall a client that, if I wanted to recall a client, I started the return, but I haven't finished it. So I go back in, I recall that return. I've already started for 2022, and I'm just going to go back in and finish it. But anyway, if we scroll to the next, so if I hit, so I'm going to go assuming that everybody's going to use this recall client here. Okay. So if I hit that button, then it's going to bring me to this screen here. It's going to have a list of all of my clients here. And based on how I indicate on this menu over this side, let me bring the program up. Okay. So I'm going to hit recall client, and honestly, I don't know if I have good data on this, so I hope this will get good information. So what happens is that right now the program is showing, I have it selected, so it's only showing my current based on what's highlighted here. It's only showing my current clients. So these are clients that I've already started for 2022. If I wanted to see just the prior ones, I could hit prior, and these are all the ones that I had from last year that I haven't done this year. Or if I want to just say all, then I'll have a mixture, and it'll be sorted based on the name or the client ID. So this will be a mixture of my clients that I've already started this year and maybe finished. And it'll be all my clients that I haven't recalled already. So the nice thing about this is that sometimes if you start a return for somebody and you don't have all the information, and then they go and they say, oh, I got to come back, I don't have everything. They come back in. If you use this screen here and you just say all, then when you go try and find their name, you find them. If it's already been started, then it's going to recall the current year. If you haven't started it, then it'll recall all the information from prior, and it'll bring it forward, and it'll show it on there. So I usually have it set to all, and that way it shows all my clients here, and I just go find the client that I want. Now, the search item, the way the names work on the full names, if you start typing the name, and you can type in any part of the name, the taxpayer's name, the spouse's name, the first name, the last name, and it'll start paring down the list. So if I type in, like if Lynette Heather comes in, and for some reason I can't remember what her last name is, I can just start typing in her first name and it finds Lynette. Same thing goes, Martha. So if I type in MAR, then I see the Margie, the Martha, the Magnolia, which is the last name. So it does a sort off of any name in there. So it just starts paring down that list. So I usually, the client comes in, their first name, their last name, I can just start typing in, and it's going to bring up the client that I want. So that's the way that full name search works. So it makes it really easy to find a client by their name. Most people, you're probably not going to find people by their social security numbers unless you have a filing system and you have those handy. But for me, it's always the name that I use. Anyway, so that's the other thing on this menu is that you can sort it by, I only want to look at the people that are accepted or rejected or that are awaiting acknowledgements. And you can do all these different lists of different statuses by clicking on the boxes here. Okay. So I can have all. This will also show, once you get in there, the returns that have been accepted will be green, ones that are rejected will be red, the ones that have been transmitted, but if I don't have an acknowledgement for both federal and state, then it'll be yellow. So it's waiting. And then if it hasn't been sent at all, then it would be white. So that is my push to use this one screen for everything. And I usually leave it as all, and then you can recall. So I call up a client. So I'm going to call up a client that I already did. This is this test person here, basic information. Let me go back to the PowerPoint. Okay, so this is the recall screen. Go to the next one. Next, you're going to go to basic information. Put in the name, address, social security number. Ideally, based on what Chris went over yesterday, you've already set up your default ERO and your default preparer, so you don't have to reassign that every time. And you're just going to put in all the information. When it gets down to the name and address, the dependent information, the dependent information, the birth dates are used for a couple things and not always sent to the IRS. The birth date, the year of the birth for the dependents goes to the IRS, and then the program uses the year, the birth date or the year to determine whether or not they're over 65 or not. And there's a couple things, and the EIC on whether or not they qualify for EIC. But it's a really good idea. We used to just, most people, we put in the age, or we wasn't that big a deal, but it's really worthwhile to just get the actual birth dates for people, and then they carry from year to year. So I think it's probably it's way everybody does that most of the time anyway, but I will push for just put the birth date in there, and then from year to year it'll carry the information. Do I have a down at the bottom of this screen here, the basic information screen, if we scroll down, we do have some there's the special filing categories, which most times it's going to default to standard deduction, but it could be dependent of another, or it could be married filing separate. You're itemizing the must itemize situation. So that's where you change those. If there's a date of death, that you put that in there. Used to be that the IRS, if you had a date of death, if the person died, like we're going to be doing 2022 tax returns. It used to be that if you put in a date of death of January 15th of 2023, the IRS would reject that. My experience is that they don't reject that anymore. And I think that that is good information to put that in, even though you're going to file a joint return no matter what, but you do have the date of death in there. Whether was happened within 2022 or 2023. I think it's information that you key in, and it's good information. If you have a joint return and there's a surviving spouse, then you leave this name of person filing return blank. Otherwise, if it's a single person, or if they both die in the same year, then you would put in who the filer was, who the who the name of the person that's filing a return. There's that box on the return where you have the financial interest in any virtual currency. Right now, it's just a checkbox, and it checks the box to let the IRS know that you had some financial interest in a virtual currency. Okay, so that's the basic information. The program will ask for as it carries over, the IRS has been asking for the driver's license information. IRS does not require it, the driver's license information. And I don't even know if there's any states that require it. But they are asking for it. So if you want to give that information, give it. I usually don't, at least not I haven't had any returns where the state has required any of that. I don't usually put in the driver's license information, but that's just me. Maybe it's a good idea to give it, but it's not a required item, so I don't do it. So once we're at the basic information screen, we have the options over here on the left, which is going to be the line input, the forms, schedules, the summary, or to actually exit out of the return. So the layout of the format of the return is that we have the basic information that we're finishing right now. Then we'll go into entering in W-2s and interest and Schedule A and everything else. And that's either going to be done on the line input or the forms and schedules menu. And that's just a preference on how you find it easier to get to where on the tax return you want to go. And I'll show you those in a minute. Or if I'm just jumping out, I've already done the return, I just need to get in there and I need to go to the summary menu, because the summary menu is where I'm going to put in my billing information. I'm going to transmit the return to e-file it. I'm going to print out some summary pages and whatnot. So you can jump to the end without having to go through the calculate, hit 99 a bunch of times to get to the final summary menu. The first time you do it, the program will ask, do you want, what's your preference? What's your preference? Do you want it to, because if I hit 99, I'm done, or 99 okay at the bottom of the screen for the basic information, it's going to remember whatever my preference is for 1040 line input or the forms and schedules. I think I'm probably in the minority. I prefer the forms and schedules because I like to just say, oh, I want to do a schedule A now, or I want to do a schedule B now, or I want to put in my wages. But like I say, I think I'm in the minority because I think most people like the line input, and I'll show you those two in a minute, just in case you're not familiar with that. So here's the two different things. Here's the line input. We have a recreation of the 1040 right on the screen. So I get in there and I go, okay, I'm going to do wages. Now I'm going to go down here and put in my Schedule B interest. Now I'm going to put in my pensions and whatnot. So it makes perfect sense that you start at the top and you go down. Like I say, we'll look more at the line input because it seems like more people prefer that method. But the forms and schedules is we just have a list of, here's the form. I want to do the unreported tip income. I go to 4137. Up here, it's kind of hidden behind this one, is the Schedule A, the Schedule B, the Schedule C, and whatnot. So matter of preference, take a look at those. You can change if you made one choice when you first did it and you decide, oh, you know what, I picked forms and schedules, but now I really like the line input better. You can go into the default settings and you can change it there. That's where it stores it. So you can always change it, what your preference is. We talked about the W-2s. So we're going to move on with that. The Schedule A is pretty straightforward. I don't think I mentioned in the tax law changes, I think I forgot to mention it, had it on my list, but if charitable contributions are deductible, but only if you itemize. So we don't get that extra $300 or $600 charitable contributions in addition to the standard deduction. So you either take the itemized deductions, which has all of your itemized deductions, including your charitable contributions, or you take the standard deduction. So that is a change, that they got rid of that little extra. We're going to allow you to take a little bit of your charitable contributions in addition to your standard deduction. So that's gone. But on the Schedule A, other than that, Schedule A is pretty straightforward. You put in the deductible expenses. It's organized just like the Schedule A is, where you put in your medical, your taxes, your charitable contributions. And then we do have, just a note, we have on the miscellaneous, I don't think I have, yeah, I don't. Down to the bottom of the Schedule A, down at the bottom, we do have a section for the miscellaneous itemized subject to 2%. And that's still gone. IRS didn't bring that back. I think that's supposed to be the case till 2025, and who knows what'll happen by then. But we left that in there because you can still take there's a lot of states that still allow the miscellaneous itemized deductions, like California still allows it. So if you go fill out that miscellaneous, the down at the bottom, miscellaneous itemized deductions subject to 2%, then the program will gather that information. And like for California, if they beat the 2% and they have some deductions on there, then it'll automatically carry that over to the California return, and it will increase the California itemized deductions by that amount. But just know that just because it's in there doesn't mean that then you're wondering, why didn't it add it in there? Well, because it's still not available on the federal, but some states still have it. So we left the input in there instead of having a whole separate input screen to go put it in once you got to the state. The Schedule B, I used to just go to the overrides and put in if it was under the 400 or under the $1,500, but now I take the time. I like to have a listing of each Schedule B item, and that way, I can compare, make sure I'm getting everything in there. So, Schedule B item, I do go in, you add an item, you can have multiple Schedule B items. Same thing with the dividends. On the dividends, when you put in, you'll put in the total dividends, the qualified dividends, if there's any capital gain distributions or whatever. Usually it kind of follows the main form that's coming off of the brokerage statements. Um, the 199A dividends is an amount, you put that in there. That's for the QBI, the qualified business income deduction, to compute that. Schedule B, Schedule D, Schedule D, Schedule D is nothing's changed on the Schedule D. You put in the individual transactions. If you want to put in the individual transactions, there's this section right here, which is the total for all short-term transactions and the total for our long-term transactions. So this would be if you have the 1099B for which the basis was reported to the IRS and there weren't any adjustments, then you can just put the number in there. So you could have a brokerage statement that's 20 pages long that has 100 transactions on it, but most of the time the basis is reported to the IRS these days, and so you don't have to enter in that whole document or individual transactions. You can just put in the total. You put in the total sales price, put in the cost, and the spouse's share would only be, there's some states that have a breakdown between how much was the taxpayers and how much was the spouses. Otherwise it puts them all together. For the federal, it doesn't care whether there's a spouse's share or not, because it combines it all together on a joint return. And you could have a mixture of everything is on here, but then you also have a couple transactions. So maybe you have a couple transactions where they had an adjustment. I think the typical adjustment is where you have a wash sale is not uncommon, where you're going to make an adjustment to that, where you don't get to basically take the loss if you repurchase the stock within, I can't remember what the time period is on that. But if you sell the stock at a loss and then rebuy it, then that's the situation where you have a wash sale and you're not allowed to take that loss. Basically, it's treated as if you never sold it. So you can have a mixture of the items, and then when you've put in each transaction, then it'll ask for the detailed information for each transaction: when you bought it, when you sold it, what you bought it for, what the cost was, and then if there was any adjustments for that. I showed you a little bit on this. This is that other income adjustments and payments. This is the screen where, and some of the times the line input screen will take you to this menu. But if you're a forms and schedules person, then you would go in here in order to put in, the typical things that go on here would be your state tax refund, which the program will carry over from prior year if you had it. You could have your unemployment compensation, your Social Security benefits, and then you get into the other income and whatnot. Those are the common things that you'll be in here for the other income adjustments and payments. Did you have any financial interest in a virtual currency? It's the same checkbox that's in the other place. So if you check it over there, you'll see it checked here too. So this is also where you're going to put in the estimated tax payments. So that's if you made estimates the prior year, then you'd go ahead and put in what those estimates were here in this section here. That's the common things you'll see on these screens. There are adjustments, like you put money into an IRA, take the deduction here, or interest on a student loan is a common one. The educator expenses, we have a line in the Schedule A for the educator expenses. And so it will take, well, that's down in the miscellaneous itemized deductions. And if you put it into the educator expenses, it'll carry to the Schedule one for the adjustments to income as an adjustment. And then whatever the balance is will carry to your state to see if there's additional amounts for the itemized deductions. But the input on this is the same as the input that's in the Schedule A. You'll see the numbers in both places. The education credits, really no changes on the education credits. You do need to make sure that when the person you select off of this little checkbox here or the menu, and it'll give you a list of who's on the tax return. So anybody you're claiming the credits for, they have to be on the tax return. So if they're not on the tax return, then you can't take the credit. So they have to be either taxpayer spouse or a dependent. And then it'll pull the name over. Then you put in the qualified expenses, which would be, you would add up. I mean, most of the time you get the 8863. I mean, you have the, what form is that? The 1098T. 1098T that has the tuition and fees expenses. You need to verify that that is what actually was paid. Also take into account what may have been paid with scholarships or whatnot. And then you add in the books and other qualified expenses to come up with this qualified expenses here. And then you do need to go into this little additional student information, and that's where you put in the 1098T information, the school, and you check the boxes on whether or not they were, have you been convicted of a felony for controlled substance if they haven't taken it for more than 4 years. There's a couple more questions, but I think there's 4 questions that you have to just review to make sure. And then we have down here, this little box down here, and that would be the due diligence, the education credits section of the due diligence, the 8867 form, which normally the due diligence, well, the due diligence covers the head of household, EIC, the child tax credit, and the education credits. So the questions that pertain to the education credits is right here on the education credits. So you'll key that in here, showing red because we haven't indicated that they qualified for it yet. The earned income credit, sorry, this is some of these items are gone as far as the qualified youth. Those are gone. But other than that, the EIC, the program, well, when you go into the EIC, whether it prompts you for it saying, hey, do you want to do the EIC? Or if you manually go into it, then it'll carry over the kids automatically. And then you need to go into the due diligence section to answer all the questions for the due diligence. So I think I have, oh, I don't have those. Anyway, on the due diligence, on the due diligence, when you go into the due diligence, then it will, you'll have for each one of the kids, you have the option to, or you need to indicate a handful of things, whether or not you have the birth certificate or the client has a birth certificate. If the names are different, there's a handful of questions, and you go through and answer those questions. We did add, a couple of years ago, we added an option to pull the due diligence information from prior year. There's a disclaimer on that saying that you need to basically verify that all that information is still pertinent. And things haven't changed. So we don't automatically do that for you because that somewhat defeats the purpose of the due diligence, that you're going through and you're verifying that that information is still valid. So we don't automatically carry that over, but we do give you the option to do that. But we have a little message that pops up and says, make sure that you verify that all this information is the same. But it definitely does save. There's a lot of clicking when you've got 3 kids and you're having to go check all these boxes. It does take some time. So I appreciate having to be able to recall the information. And we also have the option where you put in the one child, and a lot of times the same information is going to apply to all the kids. So we have the option to recall the previous child's due diligence information to apply to this one, which would be that you have the birth certificate, they lived with you, you didn't give away their exemption and all the rest of that stuff. Okay, so then now we're going to get to, so that was kind of the main things that we run into when you're keying the information for the tax return. Now we're going to look at the summary information, look at a couple things on there. We have a handful of reports. There's just the real basic summary, which tells you how much, they owe or they're getting back. The percentages are kind of nice to look at sometimes when people talk about, they want to know what percentage rate they're in and all the rest of it. So here's the summary menu here. You can do multiple states. When you're doing the states, you have the primary state and then you have secondary state. And there really is no difference between whether or not a primary state or a secondary state. That doesn't actually take any precedence whether your primary state is in the primary state slot or it's in the secondary state. It's just, if you have two states, you have two states, and there's not really one. It doesn't make a difference on which one is designated in the program as the primary state. When you go carry to the state, when you carry to the state, first time you go into it, it'll carry all the information over. Next time you go into the state, it'll ask, do you want to carry the information? Do you want to not carry? Or do you want to zero everything out and start the state over again? So the way those work out is that if you carry, it's going to recarry anything that's in the federal side. So if you go in and you put in you add another W-2, then you need to go into you need to go into whatever state it is, and you need to recarry that information so the state has the updated information. It won't automatically carry the information to the state until you tell it to carry the information to the state. Now, sometimes when you go back into the state, the reason why you might want to use the option that says don't carry is that if you're just going, if nothing changed on the federal, but you want to go back into the state to review something or to look at something, and you may have made some adjustments on the California, or whatever the state is, you may have made some adjustments on the state, then you'd want to say, no, don't carry. Because when you carry, it may trump on, when it carries, it's going to recarry the information over. And it may trump on top of the changes that you made. So be aware that how that carry and don't carry. And then the zero out and carry, I don't know that there's, if for some reason you were doing the state and maybe you were doing resident or non-resident and you finally like, oh, I don't know how everything's at, let me just start over. You can zero out and recarry the state. But I don't think that has much of a use anymore. But that will wipe out everything that originally carried, and then it'll recarry the information on the states. The next section is our e-file screen. The e-file screen, this is where you're going to actually print the 8879 right here. And then when you print the 8879, then it'll, whatever your states are, it will mark them to be, ready to transmit. And then you'll also, if you have the defaults, there's the default that says automatically generate a 5-digit PIN, which I highly recommend because it's just a made up number anyway. And when we first started doing electronic filing, we would ask people, hey, give me a 5-digit number. And they'd go, oh, and it was a big question. So I stopped asking that question a long time ago, and I just have the program generate a number, and it's just a random 5-digit number, but it represents their signature. When they print the 8879, it's the number and they sign next to it. So, but you would come in here. If you're doing a bank product, then you'd go into the bank application. Depending on which bank you're with, it'll take you to the application that applies to that bank that you've signed up with. And you fill out the bank information there. other than that, there's a couple things that just rarely come up anymore. That you check down here. You can, if you don't normally, if you're not normally, if you're doing the return, maybe you're doing the return at home and then you have to, or you're returning you're not meeting with the client face to face, or you're not ready to give them the 8879 to sign. You may want to have the default. So when you print the 8879, instead of it changing the status here to transmit, it'll change it to pending. And then when you actually get the 8879, then you can go back in and tell it, okay, now I'm ready to go. And you can manually change this to transmit in order to transmit the return. Chris had talked, I remember it was Chris or Scott yesterday talked about the electronically sign. If you click on the electronically sign, we used to require that you had the Topaz signature pad. And I'll say that if you already have the Topaz signature pad, that's the better way to go, because that signature pad is a lot easier to, it's got the little stylus, and you have the client sign that, and it'll store that, and it'll put it onto the PDF, and then you have to keep that PDF. That doesn't keep the signature with the return. It just takes the signature, puts it on the 8879 PDF, and then you need to store that PDF. But we do have the option in the program to use just basically your mouse to come up with a signature, or if you have a little trackpad, then it'll use the trackpad for the signature, and you can use that, and it probably works pretty good on a trackpad. It's a horrible looking signature when you try to use the mouse to come up with a signature, but you definitely worthwhile to take a look at that and make your choices on that. I know that yesterday when that was brought up, I saw the question come up if the Topaz signature was required or if it was still supported. But Topaz signature pad, it is a signature pad. You buy it separate. I can't remember what the price is on it. I'm not sure what the price is on it now, but you can contact our salespeople and they can point you to the Topaz website to get it. It's not cheap, but if you already have one, they definitely work better than the mouse. So anyway, and when you go to the electronically sign, it will pull up all the documents that need to be signed. So the 8867, the bank applications, and the tax return. And it'll go through a couple times the signatures, and then the ERO signature is also in there. And then it will save the ERO signature that you can reuse. So I think that is the main, what we wanted to cover today. I know the filing of the input of the tax return, I kind of went through that pretty quick, but we do have plenty of videos on our website. So if you go to our website and you go to the technical support and training section, we've done a lot of different videos on different sections of the program. We're recording these seminars or webinars sessions. So all of that information, you can go back and pick and choose different areas that you have any questions for, and hopefully be able to look through and find that on the videos there. So but that is what we wanted to cover as far as the new laws and how we're dealing with those and some of the changes in the program for the upcoming year. So we're looking forward to a good year, and hopefully everything, we won't have any weird filing extensions or last minute changes like they did to us a couple years ago with the unemployment compensation changes. But who knows, every year it seems like there's something that crops up. So we'll just wait and see what that one thing is going to be, one or two things they're going to be. Otherwise, it looks like it's going to be pretty smooth. The IRS has things going fairly well, and we're well on our way having the federal e-file approved for electronic filing, and we're working with the states and have a lot of the states approved. So we plan to have a lot of things ready to go when we're ready to start filing tax returns. And of course, we don't have any idea when the IRS is going to open up for electronic filing. They never give us that information. Sometimes we find out about it a week before. They have notified us that they are going to be doing what they call the controlled launch. Sometimes it's referred to as hub testing, but they have mentioned to us and sent out an invitation for us to be involved in the controlled launch. That controlled launch usually allows us to start transmitting tax returns about a week in advance. There's limited days on when we can transmit. Sometimes they tell us, oh, you can send 100 returns the first day, and then maybe the next day they tell us, oh, you can send 2,000 returns, and we can only send them during certain time periods. And they monitor those returns. We monitor those returns, and they'll usually certain days it's available. So when we open that up for the controlled launch, you're welcome to transmit. Those are live returns. If you transmit them, they're live returns. And as we transmit those off to the IRS. Sometimes we have more returns than the IRS gives us for an allotment, so we send them as they come in. and that can get the ball rolling a little quicker on getting the returns sent in and accepted. So that usually, like I say, that usually happens about a week before they give us the final opening date. So if I had to guess, I would say that controlled launch will be maybe around the 15th of January, but we really have no idea until they tell us. They move that date around, and last couple of years they've kind of moved it a little bit later in January. So hopefully we'll see it sooner than later, but it could easily be that we can't transmit anything, not even in the controlled launch, until more the end of January. So anyway, that's what we know. As soon as we know more information on that, we pass it on. That is definitely a guarded secret that the IRS has as far as when their date to plan to open up. And they don't like to give us anything on that until they actually have a commitment to it. So anyway, we're looking for a good year, and we appreciate you attending this seminar, and we appreciate you as customers, as clients, and looking for a good year. So thank you very much.
Thank you so much, Mike. I know that's like drinking from a fire hose, but that is a lot of information, and you need this information before the tax season starts. And so we're glad that we are one source that you can collect that information from before the start of the season. I did have another announcement to make. We do have another detailed Wintax 1040 training that will happen. The first one will be in Spanish on December 20th at 2 p.m. And then there's another one January 12th at 10 a.m. that will be in English. And so there will be an email that goes out tomorrow that will make you aware of those and give you the buttons to be able to register for those trainings. And those trainings will also be on this website on Monday when that page gets updated. So that detailed training is also coming up to add to the information that you just received from Mike. Also, we have a Texcellent subscription that will be raffled off. And I had one other prize that I had forgot to mention earlier, and that's a Taxbook web library subscription. So for the people that have attended this session, there's two prizes that will be drawn for winners. Thank you again. We have our Entities 101 that starts in just a few more minutes at 11 a.m. Pacific time. And so we will go right into that. Thank you and have a great day.